This is Sharon Garvin at Wayne State College, and this is a short 15-minute recording on variable costing versus absorption costing for the internal financial reporting class. We're running this as a flipped lesson. You're listening to this lecture on your own outside of class and filling out your own lecture outline sheets. You can stop this video at any time to catch up on taking notes on your sheet. You can listen to any of these parts as many times as you want. You can drag to skip over parts, whatever you want to do to enhance your learning about the difference between variable versus absorption costing. In class, we're going to be doing some short exercises and problems on this topic, so I will be available to answer any questions that come up as you work through them. Now, the first learning objective is to explain the difference between absorption costing and variable costing. Absorption costing is required under generally accepted accounting principles. It says that inside your product costs, which are finished goods assets on your balance sheet, or cost of goods sold deductions on your income statement, you must have four components. That is, you must have material cost, labor cost, variable overhead, and fixed overhead cost must be inside your products. A portion of the light bill, the heat bill, the property taxes, supervisory salaries, insurance, any of those fixed type of costs that happen at the factory are required under generally accepted accounting principles to be part of product costs. Period costs are anything that happen at the store above and beyond cost of goods sold, and anything that happens at the office in the general administrative area. So that's how we divide up the cost between product and period under absorption costing. Under variable costing, though, we have product costs that only consist of things that are variable that happen at the factory. That would be your materials, labor, and the variable overhead. A period cost or deduction on the income statement still occurs for your basic expenses of running your business, either in the selling or general administrative area, but fixed overhead is treated as a period cost in variable costing. That is, 100% of whatever your fixed overhead is deducted out on the current month's income statement. Doesn't happen necessarily like that over here in absorption costing. The fixed overhead is assigned to products. If the products get sold, that fixed overhead is inside of cost of goods sold. But if the products are not sold, the fixed overhead inside those units show up in an asset account called finished goods inventory on the balance sheet of the company. As far as when you use the two types of costings, if you're making a long-term decision, you do need to have your products be able to pay not only for their variable cost, but also pay for their fixed costs as well. So long-run decisions should use absorption costing information to make those decisions. If it's a short-run decision, the fixed overhead is going to happen regardless. We already learned that fixed costs cannot be changed in the short run. So if you're making a short run decision, then you should use variable costing information. Those fixed costs are irrelevant. They are not going to change under any alternative that you look at in the short term. And so they're somewhat irrelevant. You should only be using the variable cost to make product decisions for short run decisions. Learning objective number 2 is to prepare a contribution margin formatted income statement. You'll recall from the Accounting 1 class, or maybe your external financial reporting class, that under generally accepted accounting principles, we are required to use this format for an income statement. That is, sales minus anything that's a product cost. I really don't care if it's variable or fixed. Anything that's a product cost associated with items that have been sold gets deducted out in the upper part of the income statement. The subtotal is called gross profit, gross margin, or gross profit margin. Then we subtract out anything that's a period expense. And again, I don't care if it's variable or fixed. Just anything that's a period expense of operating your business gets subtracted out here in the lower part of your income statement. And the bottom line figure is called net income. Under contribution margin format, we change the order that we deduct things out a little bit. We still start out with the same sales that we had before, but then we subtract out anything that's variable. It could be a variable product cost. It could be a variable period expense. Just anything that's variable gets deducted out. The subtotal is called contribution margin. Contribution margin tells us how a particular product or product line is contributing toward the payment of fixed costs that are going to be incurred regardless, and thereafter generate a profit. The difference between the two, again, is that fixed overhead inside of cost of goods sold is only the fixed overhead attached to units that were sold. The fixed overhead attached to units that aren't sold is an asset account on the balance sheet. Over here, fixed overhead costs are deducted out 100% in the month that they're incurred. So we might have different incomes. In accounting 1, our sales volume always equaled our production volume. Thus, under either situation, 100% of the month's fixed overhead was deducted out, so the net incomes were always the same back in accounting 2. That's rarely the case. If you sell less than what you made, then the absorption costing income is going to be higher than the variable costing income. We'll show you a couple examples of how this works. Likewise, if the sales volume is greater than the production volume, we're going to demonstrate how absorption costing income will be less than variable costing income. Here's a visual aid that might help you understand the concepts. If we make the same number of units that we sold, 100% of the fixed overhead will be inside of units that were sold. 100% of that fixed overhead amount will be in cost of goods sold and deducted out on the income statement. Under variable costing, 100% of the month's fixed overhead is deducted out as kind of a period cost on the income statement. The deductions for fixed overhead on the income statement are the same. Therefore, the bottom line incomes under both methods will be the same. In month number 2, let's assume we make 100 units, but we only sell 75. So 3/4 of the units that we sold go into cost of goods sold. That means 3/4 of the fixed overhead gets deducted out on the income statement as part of cost of goods sold. 1/4 of the units are not sold. That means 1/4 of the fixed overhead for the period gets attached to finished goods inventory items which are not on the income statement. They are an asset on the balance sheet. Under variable costing, 100% of the month's fixed overhead gets deducted out on the income statement. Notice that the deduction on the income statement for fixed overhead under absorption costing is smaller than what you have under variable costing. Therefore, the income under absorption costing will be higher than the income you show under variable costing. Finally, assume in month number 3 we make 100 units, but we sell 125. As far as the effects on the income statement are concerned, every single one of these 100 units we made this month got sold. So 100% of the fixed overhead for month number 3 is inside of these 100 units that are all inside of cost of goods sold on the income statement. The extra 25 units were made in month number 2. You're selling them in month number 3. So this fixed overhead that was sitting on the balance sheet inside an asset account called finished goods inventory now gets moved into cost of goods sold. So because the extra 25 units were sold, this extra fixed overhead from month number 2 gets expensed on the income statement in month number 3. Under variable costing, we have 100% of a month's amount deducted out as a period cost, just like we did in the other 2 previous months. Notice how the deduction on the income statement for fixed overhead is a larger amount under absorption costing than under variable costing. Because of that, the income under absorption costing will be a smaller amount than it would be under variable costing. Here's another example. This one is printed in your lecture outline. It gives us some basic information about material costs per unit, labor, and variable overhead. Again, the difference between the 2 costing methods is in the treatment of fixed overhead. Under absorption costing, the $40,000 total fixed overhead for the year would be divided over the 100,000 units that we make, which crunches out to be about 40 cents per unit. The product cost would be the material, labor, variable overhead, and fixed overhead for a total of $1.40. Under variable costing, we only have the material cost, the labor cost, the variable overhead cost. So the variable product cost under variable costing is $1. The total variable cost, that is product cost and period expenses together, would be $1.10. That's $1 product cost under variable costing plus a 10 cents sales commission that we would have as a variable operating expense of running the business. The total variable cost, product, and period together are $1.10. If we look at a month where the sales volume and the production volume are the same, under both circumstances, sales would be $100,000 times the $3 selling price. Under absorption costing, cost of goods sold would be the 100,000 units times the $1.40 cost, and then the subtotal is called gross profit. Then we take out any period expenses, which would be the 10 cents per unit sales commission, and a $10,000 fixed amount of general and administrative and selling expenses. Bottom line net income is $140. Under variable costing, from the sales, we take out anything that's variable, which is $1.10 product and period expenses that's variable per unit times the 100,000 units sold gives us $110,000. Subtotal is called contribution margin. Then we take out anything that's fixed. The fixed product cost is the fixed overhead. The fixed period expense is that fixed amount of expenses that we have for operating our business for a total of $50,000 in fixed costs, bottom line net income. The 2 incomes are the same because all of the fixed overhead incurred in this period was inside of units that were sold. under absorption costing and was deducted out as a lump sum, as it always is under variable costing. If we have a situation where we made more than what we sold, let's say it's year number 2, and we made more than what they sold, the sales on both types of income statements would be 80,000 units times this $3 price. Over here in absorption costing, cost of goods sold is 80,000 units times the $1.40. Over here, the variable cost per unit is 80,000 units times the $1.10. Subtotal over here, gross profit. Subtotal over here, contribution margin. Here we take out any period expenses, the 10-cent sales commission for each one of the units sold, and the 10,000 fixed expenses. Over here we take out anything that's fixed, which is a lump sum of $50,000, and we notice the net incomes are different. The net incomes are different because there's a 20,000 unit difference between the number of items that we made and the number of items that we sold. There is 40 cents of fixed overhead inside each one of our units under absorption costing. So the 40 cents fixed overhead inside the units that were not sold, that's these extra 20,000 units, which is $8,000, got moved to the balance sheet and is sitting inside an account called finished goods. The whole $50,000 fixed overhead under variable costing got deducted out in the current period. This one got postponed. There is $8,000 fixed overhead that is not inside this number. It's in an asset account on the balance sheet. So their income is $8,000 higher. For year number 3, let's see what happens. Let's assume we sold more than what we made. The sales are the same under both methods, 120,000 units times $3 a piece. Cost of goods sold $1.40 under absorption costing, variable costing $1.10 under variable costing. Subtotals called gross profit. Subtotal over here called contribution margin. Take out your expenses, that's a 10-cent commission on each of the 120,000 units and the 10,000 fixed expenses. Anything that's fixed over here, a lump sum of $50,000. Notice the incomes are $8,000 apart. Why is that? Well, there were a difference between the production volume and the sales volume of 20,000 units. Each one of those under absorption costing had 40 cents of fixed overhead inside of it. That was deducted out in the current year's income statement because those units that were made in year 2 finally got around to being sold in year 3. So that fixed overhead that was postponed being recognized on the income statement from year 2 gets recognized here in year 3. Because we have a larger deduction of fixed overhead costs under the absorption costing income method, our income is a smaller amount than it is under the variable costing method. One of the things we want to talk about absorption costing is the ability of managers to manipulate profits and thus possibly manipulate their performance evaluation. If you use absorption costing, okay, and we just showed you that absorption costing will give you a higher income when you produce too much, managers will be encouraged to produce too much. So we use an extreme example here where a manager is promised a bonus if they can increase income. They decide to double production. Now under JIT, just-in-time inventory, we know that's a bad thing. You're making many more units than what you need. As far as sales are concerned, it's very costly for the company to have the carrying cost to have those particular extra items on hand. But it does make the manager look good. Now we have $40,000 in fixed overhead, but instead of dividing it over 100,000 units made, the manager who doubled production would have the 40,000 divided by 200,000 units made. The fixed overhead inside each unit would not be 40 cents a unit, it would be 20. By selling only half of the items we made, we only have half of the fixed overhead deducted out on the income statement this year. And that means the profit goes up from 140,000 like it was in year number 1 to 160,000. The manager looks like they increased the profit of the business when all they really did was increase production. They didn't really sell anymore. The company only looks better from a financial standpoint because you use absorption costing and postpone recognition of some of the fixed overhead by putting it inside a finished goods inventory account on the balance sheet. Having too much inventory on hand is not in the best interest of the company. Thus, for performance evaluation on managers, you shouldn't be using absorption costs. You should be using variable costing. Variable costing, again, in the short run, says fixed costs are somewhat irrelevant. Notice under variable costing, if you sold 100,000 units, you get the same income under variable costing in year 4 that you had in year 1. The theory is, again, I sold 100,000 units both times. Shouldn't the income be the same amount? You cannot manipulate by putting fixed overhead on the balance sheet, because 100% of the fixed overhead is deducted out as kind of a period expense under variable costing. So you can't really manipulate the system as a manager and do things that aren't in the best interest of the company. That is, make too many units under a JIT environment where we're trying to keep our inventories as limited as possible. This ends my screencast for variable versus absorption costing.